Hello, everyone. Today we're diving deep into a critical issue that's reshaping lives across the UK, the financialization of the housing market. We'll explore what it means, how it started, and the profound impacts it's having on people's lives, especially renters and the younger generation. We also look at who benefits from this and the risks that this poses in the future. The resources for this research is from two articles, one from New Economics Foundation titled Financialisation of UK Homes and the second titled Financialisation, Real Estate and COVID-19 in the UK by Grace Blakely. Financialisation refers to the process where financial markets, financial motives, financial actors, and financial institutions in the operation of domestic and international economies in the UK. This process has transformed housing from a basic need into a financial asset, a commodity to be bought and sold, not primarily a place to live. This has had a largely negative impact on the UK economy and has led to social and wealth inequality, financial instability, and increased rate of poverty in the UK. The shift began in the 1980s with significant deregulations and the privatization of social housing under policies that promoted homeownership and allowed for the trading of financial securities backed by mortgages. This led to an explosion in house prices, and this has resulted in significant wealth gains for landlords and house owners, but increased the rents for the private rented sector and transformed homes into vehicles for investment. Let's go back in time and look at this in detail. When Thatcher came to power in 1979, capital controls were removed and controls for credit creation were loosened. So-called bank corset was removed. This caused a significant increase in monetary supply owing to an increase in bank lending. The bank lending more than doubled as a percentage of GDP in 5 years. The Building Societies Act of 1986 allowed the building societies to function as traditional banks. Prior to this, they can only lend the money that is saved with them. This means that they can only lend at higher rates to enable them to attract savings. Once they were allowed to function as traditional banks, they started lending at much lower rates. The Right to Buy scheme of 1980 allowed local authorities to sell social homes to social tenants at a reduced price. Reforms were made to ensure that credit was available for those seeking to buy under the Right to Buy scheme, and many were able to take zero-deposit mortgages. As the lending rose, the house prices increased substantially. This created a speculative feedback loop where investors would borrow to invest in real estate in the hope of increasing prices. A number of complex financial instruments were created to securitize these mortgages, including mortgage-backed securities, collateralized debt obligation, and credit default swaps. The revenues that came with these securities was an incentive for the banks to increase mortgage lending, and credit standards were relaxed. Northern Rock, for example, was lending 125% of the property value. Mortgage lending increased 20-fold between 1997 to 2008, rising from 20% of GDP to 70% in 2008. UK house prices were rising at twice the average rate compared to European counterparts. The management of the social housing stock was given to housing associations. The wealth effect created by the increasing house prices encouraged people to spend more, which sparked a consumer boom. The relaxed lending standards led to the subprime mortgage crisis of 2008. The government had to bail out Northern Rock and Royal Bank of Scotland. After the crisis, the central banks reduced interest rates nearly to zero. But because the government started austerity measures in the wake of the financial crisis, the economies remained sluggish. In order to stimulate the demand, the central banks embarked on quantitative easing, where the central banks would purchase assets, which would theoretically increase the money supply and boost bank lending. After the financial crisis, With returns from bonds and stocks low, cash-rich investors bought up properties in the hope that the prices would go up once the economy recovers. As prices started to increase, the banks started to lend more, which caused the prices to go up even more. The introduction of REIT, real estate investment trusts, speeded up the process. The financialization of housing has led to several negative outcomes. Wealth inequality. Homeowners and investors have seen their wealth grow due to rising property values, while those not on the property ladder and young people face increasing rents and barriers to homeownership. The UK is already an unequal society, with top 10% of the people owning 44% of the nation's wealth. The UK household wealth increased from £2.5 trillion to almost £12 trillion in 2020. As the wages have not kept up with the prices, only the wealthy could afford to buy houses, increasing wealth inequality. The median house price to earning ratio rose from around 2 to 8.3 in 2021. Landlords have profited a lot from rising house prices. The younger people, however, found it increasingly hard to get on the housing ladder. In a recent survey, 40% of the mortgage applications made by 16 to 24-year-olds have been rejected. Renting and living longer with the parents are the only options for them. Housing affordability crisis. As housing becomes a commodity, its affordability decreases, pushing the dream of homeownership out of reach for many, particularly young adults. Research by Shelter shows that only 50% of today's young people can expect to own a home. In the past, they were able to get a larger mortgage for low interest rates. However, since the financial crisis, the introduction of affordability criteria means that many cannot get the mortgage. Rather than going to first-time buyers, new-build houses go to already rich people who have the capital to buy the property outright or the capital to secure a mortgage. At the same time, the number of social houses available to rent has fallen, and the private rental sector is now the only option that many renters have. The rising house prices and the fall in social housing has led to ever-increasing rent prices. The average private renter spends a third of their income on housing costs. This rises to 48% for renters between the age of 16 and 24, making it harder for them to save for a deposit to buy a home. Financial instability. The market's dependence on real estate speculation can lead to financial bubbles, risking economic stability when they burst, as happened in 2008. It also reduces the central bank's ability to raise rates to control inflation, as this will lead to collapse of the housing market. The UK government is estimated to have lost £23 billion bailing out the banks during the financial crisis and had to guarantee £1 trillion worth of bonds. If we have another crisis, the amounts involved will be much larger. This can happen if the wages do not match rising rent prices and people are unable to pay rents to their landlords. This can cause housing prices to fall and cause a negative loop of falling prices and reduced mortgage lending. The pandemic has exacerbated these issues. With economic instability and job losses, more people are struggling to afford housing. Simultaneously, investment in housing as an asset class has remained robust, further driving up prices despite the broader economic downturn. The record amounts of liquidity pumped into the system and ultra-low interest rates pushed more money into the housing market. After the pandemic, the central banks increased the interest rates in an effort to control inflation. This only increased the cost of rents in the private rental sector, as landlords who have taken mortgages for their buy-to-let properties simply passed on the increased mortgage costs to their tenants. Looking forward, what can be done? It's clear that without intervention, the cycle of financialization will continue to create inequality. Solutions might include regulating the housing market, implementing policies that discourage speculative investment in housing, increasing affordable housing, investing in social and affordable housing to ensure that everyone has access to decent, affordable homes. This is one area the government can act. In an article published by New Economic Foundation, the government will spend £58 billion subsidizing the rents for tenants in the private rental sector. This could have been used to build more social housing. Mr. Gove has promised to build 30,000 new social houses this year. Support for renters. Strengthening protections for renters to prevent exploitative practices and ensure fair rents. Priority given for first-time buyers and young people to buy new-build houses. As we've seen, the financialization of the UK housing market is not just an economic issue but a social one, affecting the very fabric of our society. Reversing this trend will require concerted effort and political will, but it's essential for the health and stability of future generations. So the winners in this are the banks, landlords, and the already wealthy. The government gets higher stamp duty from rising house prices, which stands at £15 billion. Totally from the right to buy scheme, the government earned £47 billion. But as you can see, it will spend £58 billion subsidizing the rents of tenants in the private sector over the next 5 years. So overall, the government loses out. Thank you for watching. If you found this discussion enlightening, please like, share, and subscribe for more insightful content. Let's keep the conversation going in the comments below. What do you think can be done to solve the UK's housing crisis?